I think that absolutely. I think China in particular will have a huge say, or is having a huge say. I mean, they were actually the ones that brought up the SDR back in 2009 that caught my attention, because what is going to be the new currency? And that was the question, because the system really died in 2008. So yes, 100%, and we've also had the IMF say that they're going to put their headquarters, which is now in Washington D.C., but in China. So yes, I think the U.S. will have a level of say in it as well, but I think China, above all else, will have the most say, and I think they're showing the world how to control their citizens and their population. Initially, now I'm not saying 100%, but the fiat money system is a Ponzi scheme. And so you need confidence. And by the time they reset the global currencies, the confidence in the powers that be and in, the central banks and the governments, I mean, we've watched it wane over many years. It'll be gone. And so if they want the population to use the money, which of course they do, it's how they'll stay in power, then yes, their history tells us that and the IMF has also discussed it, there will be a component of gold in the new currency to stabilize it. And then over time, I think they'll take it out again, because that's also what history shows. But yes, I definitely do think that gold will be a component of the new money for a while anyway. Well, I mean, they ran that test in October, and then they postponed the US dollar LIBORs until 2023. Now, they are pushing and creating the SOFR to take over, and they're putting the fallback languages in all of the contracts so that they can automatically shift. But there's still too many contracts that are being created that have LIBOR in the fallback language. And this is just a huge experiment. And who really knows? I mean, the last time I checked, it was 640 trillion in notional value of those derivative contracts, which means, who knows what the real value is at risk. We're looking at the quadrillions. But yeah, do I think the system can withstand that? Well, time's going to tell us, but apparently they couldn't when they were originally scheduled, and they have from 2012 until 2021 to make those adjustments and those shifts, and they were unable to do it. And even during the beginning of the pandemic, as Fed Chair Powell was pushing out all these loan programs and really had the opportunity, I felt, at that time to really build out their new interest rate program, he still used the LIBOR. Even he went back to using the LIBOR in the contracts. So there must have been something in there that meant that SOFR, the U.S. contracts in England, you have a different one that is much further along. But, there had to have been something in there that prevented him from just linking those to SOFR. Yeah, I think it's a big fat experiment that is, in my opinion, most likely to go horribly, horribly wrong. Depositors will be on the hook. Taxpayers will be on the hook. But, we're going into a hyperinflationary environment because everybody's already on the hook. This isn't something, unfortunately, it's not something new. In that same act, basically it said that the government can come in and commandeer and confiscate everything. So like, I'm growing food. If they want my food, they can just come in and they can take my food. I mean, the market is bigger than the central bank's ability to buy the bonds, let's face it. Especially with all of these derivative products. They don't even have to buy the bonds. They just have to put out a couple of bucks and buy derivatives against interest rates or credit or what have you. So I think what we've been watching, actually I know, what we've been watching as witnessed by the Treasury VIX is the handing off of control of the bond market to the traders. And we recently went to a new level in there. So when you see a big spike in interest rates, it's because of the loss of confidence in the central bank's ability to control things. And that's already happening. I mean, we've been watching this question come up for a number of years now. So, yeah, big spike in interest rates, which I'm paying attention to as well. Yeah, they're between a rock and a hard place. You know, if they raise interest rates, what's going to happen to the stock market, right? And the stock market is benefiting the few at the top, and it's also making like pension plans and different things look better than they really are. So, yeah, we're in a mess, and we're at the end. Yeah, the cost of everything is going up and probably exponential pretty quickly here. And that would also have a major impact on interest rates. But I agree with you, Mario. They'll just keep buying it because, what, they just keep printing money and creating more debt. But it'll only work until it doesn't. And with interest rates even up, 1.6, wherever they are right at the moment, it's kind of showing you that they're starting to lose control. And look at that Treasury VIX, which I think they have now taken away because we don't want to know what's going on in the Treasury market that's the foundation of the global markets. Oh, heck no. Let's not know what that is. Well, we can see it in a bunch of different ways, but inflation is an intentional wealth transfer. Because, and we've seen it in income and wealth inequality. In the early 70s, the average CEO made 20 times more than the average worker. Now it's over 300 on average, 300 times or so the average worker. And that's thanks to inflation. And we know that back in the 70s, the average wage was $9,500, and a family of four could live on that with one wage earner. Today, well, you're getting stimulus checks. If you're making $150,000, you're getting stimulus checks. So that is how the wealth transfers on many, many levels, but also during a crisis. So if we think back to 2008, when most of the people that owned single-family home rentals were moms and pops.